Hi, my name is Elizabeth Cross-Nickel, and I am filling in for John Seacrest today. I'm delighted to welcome you to our Seattle Angel event this evening. And we are going to be doing a visit with Javier Soto and David Grampa talking about Ask Me Anything. And so this is opportunity for investors or founders to ask what investors think about certain topics. We're going to do a quick introduction. I helped John with Seattle Angel, but also with two other programs, the Transatlantic program, which will be running again in September, and Alex is going to talk about the Seattle Angel Conference. I also work with the APIS Health Angels program, which is going to be doing education workshops in September. So if you're interested in healthcare investing, then please join us there. And then we'll run the conference investor company match starting in February. And we appreciate you all joining us tonight. So happy to hear about your experiences and what questions you have that you'd like to have our panelists talk about. Nathaniel, maybe you'd like to introduce yourself.
Sure. Thanks, Elizabeth. Hi, everyone. My name is Nathaniel Hudson. Currently, I'm working in talent acquisition at Amazon. I'm also getting new to the angel space, interested in the ecosystem and the community aspect of it, sharing resources, ideas, but then the educational component too, right? So I really like the idea of building that ecosystem, and that a healthy ecosystem is good for all. So I've been helping out with Elizabeth and John, just doing some back-end operational stuff, and excited to learn some more this evening.
Okay, so Javier, I'm going to turn it to you to introduce yourself. And then maybe after you say a minute or two, we'll get it to David, and then you can take it away.
Okay, my name is Javier Soto. I am originally from Spain. Been living here in Seattle in the US for the last 10 plus years. I've been doing angel investing since 2016. I started in Seattle Angel Conference. And I have, over these 7 years, a portfolio of around 22 companies. And that's it. I have a background in industrial engineering, although I ended up kind of managing a small equity fund. So I've been all over the place. So I have a very kind of broad kind of experience of a lot of knowledge in all over the place, but very, very shallow. So happy to be here.
And David Grandpa.
Hi, I'm David Grampa. I'm an entrepreneur turned angel investor. My last company I bootstrapped, and I moved to Seattle back in 2015, and got involved with Seattle Angel Conference shortly after arriving, and so started to angel invest with the Seattle Angel Conference. Was pretty active angel investor in the Pacific Northwest for about 5 years. I have 20 plus direct deals, and I'm an LP in a number of funds. Currently, I am acting venture partner at a local VC fund called Graham and Walker Venture Partners. It's a $10 million fund focused in early stage investing. And I haven't been very active with Seattle Angel Conference the last couple of years, so this is great to be back. Great to see you, Elaine.
Yeah, we missed you.
Well, I'm definitely going to get involved now that it seems that it's back in swing. So,
all right.
And well, I'm so excited about, we'll ask you some more about what it means to be with Graham and Walker, because they just launched this fund, and maybe you could tell us a little bit more about the operations of launching after we get some of our other discussions on. So I'd like to kick it off by saying you each told us a little bit about your background and how you got into this angel investing. And it sounds like there was a common theme with SAC, which is intended to start people to be a little bit more informed about what they're doing. But you had an operational slant to this, Javier, when you that you were able to bring skills to that. So what do you think is the background that people should have when they come into angel investing? Is there some particular knowledge set or a mindset or a skill set? And I think I might have an answer on this one in terms of mindset, but if you could just give us your thoughts.
Yeah, I think that yes, absolutely. You have to be an absolute specialist on common sense. You don't need to be a technical, you don't need to be a developer. You don't need to be a scientist. It's just pure common sense and curiosity. So if you have curiosity, you have the willingness and the ability to learn about different spaces, and then you have the basic experience, life experience of having dealt with people, teams, etc. With a bit of common sense, that's all that you need. I have seen a lot of people in Seattle Angel Conference who start and they are saying, well, but I come from a profession of teaching, and I can see that all these companies are software companies, and there's machine learning, and there's all these strange things. It's like, how can I evaluate them? And after the process of going through Seattle Angel Conference, they realize that they are able to form very, very good opinions based on very solid due diligence. So you do not need to be a technical expert. You just need to put the hours, and you need to have the ability to learn different stuff from different places. That's my take. David, do you think differently?
No, I agree 100% with you. I think having curiosity and motivation to do it is really, really important. I think Seattle Angel Conference is a great way to get that experience with a minimal check size, which is not often available to individual angel investors just starting out. But I think that everybody brings a unique take in their evaluation of startups, and you don't necessarily have to get into it with some big thesis or any knowledge. It's something that you can graduate into slowly. And as Javier mentioned, if you have a willingness to learn and a natural curiosity, that stuff's just going to happen automatically over time as you get more interested in a founder, or more interested in a market, or more interested in a particular business model or operation. You're going to start to use common sense and your other world experiences to try to form some sort of abstraction of that and try to unpackage it and understand it better. And each time you do that, you'll learn more and more about startups, and you'll notice that a lot of the things, particularly at the early stage, there's a lot of commonality between startups, and you don't necessarily have to have technical or any sort of special knowledge in order to approach learning about that startup and learning about that team and what their ambitions are and the market they intend to operate in.
And I would even say that willingness to learn, there's tons of resources. So for example, I did a Coursera course on machine learning, one that is super easy from one of the founders. Or you can do NLP courses, and it's just just to get a flavor of how things work. And the same with courses about blockchain. And you have a lot of resources in terms of lectures, in terms of videos, in terms of articles out there that you can find with a Google search. So there's a lot of information out there. So you don't need to be a specialist. You just need to know enough to be able to know if someone is selling you something that is solid or not. So it's like, hey, we have AI. Yes, we have a lot of artificial intelligence. And it's like, yeah, but what model are you using? And it's like, oh, it's regression analysis. Oh, yes, I learned that in high school. It's like, okay, that's machine learning, yes, but it's at the most basic. So you can get a lot of the handle of things by just getting a bit deeper into things. But everybody can do it. That's the key.
But this is good actually to hear, because at some point, John Seacrest often says, what's your investment thesis? And I think people who are new investors have a little deer in the headlights and think they don't quite know what that would mean in terms of how to drill down into the different companies. Can we go to the next level down and say, what should you be looking at when you're looking at, now you're curious, but what characteristics should you be looking at that might be across all companies? I'm thinking maybe the TT team traction.
Yeah, in terms of a space, I tend to know what I don't like so much, and what I like a little bit more. So I like very highly scalable businesses which tend to go towards software. I don't tend to like healthcare, medical devices, drug discovery, because for me that is very capital intensive, is very long term. You are not going to have any idea of if this invention is going to work in the market until many years down the road. So you are in a very long research and development phase where everything is out of your control. You are just researching, there's the FDA, there's a certain number of things. And I prefer much more the fast feedback loop between customers and founders. It's like, does this work? Are we trying to find some kind of fit between the problem and the solution? What are we learning? How are we moving? Are we getting some kind of momentum? So that's the thing in terms of the space. And then in terms of what do I look for? I suppose that I've been evolving throughout these years. I think that I have ended up in a place where team is 51%, 55% of the equation. And then the second part, the another 40% would be the customer, meaning that is this really a problem that anybody cares about? Is this really added value? Is this really adding value? Do you have any proof about this stuff, that people like it, that people use it, that people are willing to pay any kind of cost? And then there's a 10% that can also decide things in terms of unit economics, projections, valuation, competition, etc. But I think that the two main things that I look for is, are the founders the right founders for this? And second, are the customers the right customers for this? Does this make sense from the point of view of the customer?
Thank you. And David?
Yeah, I think my thesis has certainly evolved over the years, and I think that should be expected if you get into angel investing, particularly if you intend to do it for the long term. And I think it does take the long-term outlook to be successful. You have to diversify over a lot of different teams, and you have to diversify over time. And so as you can start out, I think, initially very high level, just set a thesis of, I intend to allocate this amount of capital to doing angel investing as part of a high risk, high return portion of a portfolio. And you have to look at it, it's very active investing, right? You can't, it's not something I think you can be successful in passively. And so while, other parts of your portfolio, you can passively invest, angel investing, you have to commit a certain amount of time. And so I think you have to be, in terms of your thesis, you have to establish that up front, right? I'm going to do this amount of diligence each year. I'm going to meet with this many entrepreneurs. I'm going to, attend this many conferences or read this many books or look at this many resources online. But there's a lot of time that goes into it. So I think you can start there. And if you just make that commitment, then you'll start to gain experience and form a little bit better thesis. I think all angel investors have different theses, as well as venture capitalists, and that's what makes the system work very well. Is when all of those different evaluations, opinions combine to capitalize companies, and so you don't have to have. I mean, it's better to form your own thesis, but I do think that there's a commonality, and I agree with what Javier said about team. And also, Elizabeth, when you mentioned the T's, right? There's like, I don't know how many T's we're up to now, but the ones I focus on are team traction and terms. And really focusing there's a combination of some of those other T's when you get into it, if you think of total addressable market and things like that. But from a traction standpoint, I'm always looking for companies that have some sort of traction. And I think the reason that's part of my thesis is that it's become much easier to start businesses today. The cost to start a business, really, to find an initial customer and build a product. I mean, with technical advances, you can get to customers very quickly and scrappily. And so if entrepreneurs or teams don't demonstrate traction, to me, that's just, they're asking for permission from an investor. They're stating that they need these funds or they need these other things in order to execute. And I just don't think that that's true. It certainly is for companies like Javier mentioned. A pharmaceutical, of course, there's going to be a large capital expense. But software companies, other companies that apply leverage in the form of technology or in the form of relationships or maybe even subject matter expertise, they should get to traction really, really quickly. And so I kind of work back from traction to understand the problem and the solution. And this is something that's common to every startup. And this is where the common sense, I think, comes into play, and why the problem solution sort of pitch framework has become so popular in the last few years, is that a problem should be very clearly stated, right? And it can be stated in terms of the customer. And when that problem is stated, it should be self-evident what value there is in solving that problem. And you can quantify that value, right? And so at some point, the question becomes, is the solution more expensive, right? Is it too costly, right? Because there's a lot of solutions to problems that are more costly and you can't profit from those, right? And so then you start looking into business model. You eventually get to traction and work back and say, okay, well, this is evidence of all these other things that I've made assumptions about in terms of business model, in terms of the market they're operating, the problem that's stated, and the solution that they're proposing. From there, you get into that other T, the team, and team that's a complicated question, right? I think that I've over the years have, especially at the early stages, shifted my focus to just treat this as a sort of a talent, as a talent game, not so much more as investments. Like, you're trying to invest in talent. And so I kind of would probably say it's maybe 80% of the equation, because again, you kind of assume all those other things are true about the market and stuff. If you think there's a worthwhile business opportunity there, then all you care about is this team, can they execute on that? And then that leads you into terms, because they're asking for your help in that, usually as an equity partner. And those terms have to make sense. It has to be commensurate with the opportunity that's available, and it has to be commensurate with the level of risk that you perceive in the team's ability to execute on their vision and such. So I really focus on those three, and if I can kind of quantify the risk reward ratio between all startups, right? You're looking at the value, you're looking at the value of their solution, you're looking how big that market is, the probability of them executing, what success looks like, who's going to buy it in the end of the day, right? How are you going to get liquidity? And you can work back and then find that you can make apples to apples comparisons between different startups. And that's where it gets a little bit transactional, because you're highly focused on investing in talent and teams, right? But at the end of the day, it is a transaction. You have to combine it with a large number of other transactions. And so really you're going to invest in the best entrepreneurs with the lowest cost of risk that they're providing, right? Relative to the opportunities presented. So you make those investments over a long period of time and they form a portfolio. And so that's kind of my thesis, is invest in teams, focus on risk and reward, and do it over a long period of time. It's easy to fall in love with entrepreneurs and ideas and markets. It's much harder to actually look and evaluate the risk of the enterprise compared to other opportunities that are available for your capital and fund startups that solve problems.
Would anyone like to ask? I have a list of questions, but does anyone want to jump in and ask one that is burning for them?
Yeah. Hi, this is David. David, I know you mentioned a couple things about trying to find commonalities and then finding the right teams. Is there like a couple commonality threads that you look for and, hey, this team's able to execute their plan?
Yeah, absolutely. I think, it's the commonality is, do they have the skills that are relevant to the task that they're, right? So if it's a software company and there's no software engineers in the founding team, that's a problem, right? If it's a company that's maybe a consumer packaged good where it's mostly commoditized as to the product being sold, but there needs to be big marketing. If there's no marketer on the team, that's a problem, right? So the team has to have a composition that is capable from the onset of getting to the next step in the startup as they define it, right? And it has to be a step that you agree with, right? So if it's, say, for example, early stage software company, and they say, well, we need to, we're gonna need 6 months and $500,000 to run R&D. You first have to agree that's worthwhile to do that R&D, right? It's like, if they run this R&D and if they're successful and if this experiment proves to be successful, then they come to the next step of raising more capital to unlock more market value, right? And so you got to agree with the step, but then you got to look at, say, well, do they have the skills in the team composition to achieve that? If there's something missing, that can be a problem. You can quantify that as a bit of risk. The other thing I think that's common is, and that that should be obvious, right? The team composition. What's less obvious is sort of the human factor there. I like founding teams that have worked together in the past. Maybe they've worked together on a team at Amazon or Microsoft or in a previous startup that failed. As long as they've demonstrated that they've, over a long period of time, have worked well together and accomplished something, that de-risks an investment for me. If they're previous founders, I always like that, right? If they have previous startup experience, because they've at least learned, you know, how to fail, right? Or maybe how to succeed. But they've gone through it once, and they're not going to repeat a lot of the same mistakes. So that's a little bit of de-risking. Diversity in team is very important to me. I think diversity of experiences and diversity of skills and diversity of thought, right? You know, I don't care so much about outward diversity, but I think it's important that teams have diverse way of thinking, because if there's only one person making all the decisions, that's bad. I believe in wisdom of the crowd, and I think the more people you can get involved in decision making, more people you get involved in execution, then the more likely that the team is able to accomplish what they're setting out to accomplish. So that's very important. And then there's other characteristics on an individual level that I think is common to not just startups, but, you know, working with people and the relationships you choose to have in life. And that's people have to be, you know, they have to have integrity, of course, right? Integrity is super important. You know, Javier talked a little bit about curiosity before. I think it's important in this business, you know, creating companies and solving problems where nobody else is willing to do it, right? Like leadership is important, but curiosity is important. You're looking for those lifelong learners, people that aren't egocentric, right? They know what they don't know, and they want to learn more, and they're comfortable learning more and figuring out they know less, right? So you want entrepreneurs like that are naturally curious. I think coachability is something that's really critical. If you have an entrepreneur, and this is a balancing act, because you need them to be confident to make decisions without seeking, you know, the advice of others. But they need to be people that are willing to listen and willing to learn, but also willing to make hard decisions. And so I think that's important. It kind of goes back to the curiosity element as well. And vision, right? Like, I think that's important. It's without vision, they're not going to survive the journey from beginning to end. I think, you know, they need all those other characteristics and qualities as well. But if they don't have this long-term vision and want to achieve it at all odds, like, and have that grit and are in it to the end, then that, you know, that's a problem for me as well. So they have to be very committed with a long-term vision.
Great. That's a very detailed answer, and it all made a lot of sense. Thank you. And just to follow up, if we have a second, if Kevin's still on, we're in a unique situation where we're all first-time founders and have not worked together before. Is there a way that a team with that is able to kind of display to you that there is a lot of continuity and like kind of chemistry between the team?
I don't think you necessarily have to demonstrate the continuity. You know, that if you don't have proof of it from before, it's not like you know, there's no exercise you can do, or, you know, like personality tests or things you can take that say you're going to work well together in the future. So you just have to start demonstrating it, right? So one way to do that is start building.
Yep.
Right? Your startup is something you are working on together, and so you should, by the time you approach investors, you should have something to show for that. And so whether that's building a prototype, or having run some marketing tests, or you know, interviewing customers, or doing market research, there's some activities that you could be working on together that is proof of your ability to work together.
Got it. Thank you.
Elaine.
Great. Javier and David, question for you guys. Since team is kind of rising to the top for both of you, do you have any examples of kind of teams where you took a path and what that was? So one of the things that sometimes is a red flag for me is teams that are taking high salaries, because I don't necessarily want my investment to fund a high salary. I want it to fund the next milestone. Do you guys have things that you've seen in the past that raised a flag for you? Because it's great to hear both the positive things you're looking for, but also those negative things that have caused you to say, well, I'm picking up.
Okay, so for me, the way I look at it in two ways. There's the functional, and then there's all the psychological stuff. The functional is that in your startup, you're going to have a few engines which if they don't work perfectly, the startup is going to fail. So who has the domain expertise? Who has the development or the engineering expertise? Who has done this before? And can we evaluate that? Who has the sales or the marketing experience? Who has done a similar job of selling this kind of stuff or talking with customers in something similar or related, so they can leverage that experience? So that is a question of experience in terms of a balanced team from the functional point of view. If they don't have one of those things, and it's a key role, it's a key engine, it's a key function, then it's going to be complicated unless they have a very good plan of how they're going to solve that in the future. Right now we are developing the MVP. We have these pilots lined up because of our own relationships in our engineering background, and we are already allocating this amount to find the VP of sales that is coming in 6 months when everything is ready. Okay, so there's always a context. In terms of other red flags, what David said in terms of self-awareness, for me, a huge red flag is not saying the truth or leading me to believe things that are not true. Like, hey, we have sales of $1 million. And then when you look at it, you realize that the sales are consulting on the side, someone else that has nothing to do with the company. It's like, well, it is true that it was done by the company, but it has nothing to do with what you are telling me. So those are not sales of the company. So very important, you cannot lead people to believe things that are not true. If you don't have the ability to put yourself in someone else's shoes, to understand what they are listening to or what they are hearing, and they come to the wrong conclusions, when they realize it, they are going to run. And you are not going to look good. So that is super important. To be honest, that doesn't mean that you don't frame things in the best possible light, that you can do, and it's absolutely okay. You have to frame things to your advantage, but you have to give the context. So be careful with that. And then there's all this other psychological stuff. It's like, is it a balanced team? Do they have, as David said, the visionary? Are they operators? When you are asking them about it, they are a little bit more advanced startup. It's like, do they know the names of their customers and who they are calling with? Who are they going to call next? Do they have a funnel? Are they on top of things? Or is this something that they are going to do in the future? Oh, yeah, we're going to do this. But yes, first I'm going to get the money, and then we're going to go and take the phone, and we're going to do SEO. Yes, we're going to put Google ads. It's like, yeah, sure, great. No. You need to be talking with your customers from day one. So where are those things? Do they have that mentality of the restaurant owner who knows every single patron that comes, and he knows the regulars, and he greets them, and he knows exactly how the business is going day to day at the early stage? Or are they a corporate person who tends to manage humongous budgets for a unit in Microsoft or in Amazon, and they don't have the experience of being in the trenches like a startup is going to be? So there's a lot of things that's why I say that you don't need to be an expert. You just need to have the common sense to begin to get the vibes, because there's a lot of signaling going on where you can begin to understand the psychology and the point of view of the founders. So all the things have to be coherent about this ideal personification of a founder who is someone who's driven, who has a founder fit, who really knows why they are doing, so they are not going to drop the ball when things get hard. Someone who's absolutely obsessed with their customers, someone who's talking with them, who's pursuing them, who's almost stalking them, someone who's really developing the funnel even before the MVP is finished. And that is because nobody has to be everything. You can perfectly well have a team where you have the visionary, someone with a head in the clouds, who's thinking long term and who sees a future that no one else can. But he's able to move everybody in the same direction. And then you have the operator, who's the executor, who's doing all these things and has all these things in his head. So you can have balanced teams with different parts that complement each other, being orthogonal and all of them rowing in the same direction. And all those things you are going to get with conversations with them. And then, are they flexible? Because many startups start in a place and they end up in a completely different way. So it's like, do they have that flexibility to follow the money? And for that, we go back to, do they have that hunger for the customer to fulfill customer expectations and needs, with the smarts to know where is the money, where is the highest added value, the highest margin possible. Because it's not a question that you're going to pivot, hey, we are Slack, we are starting games, and we end up doing this other thing because I don't know why. No, it's like, I'm following my customers, I see that this doesn't work, but there's this opening here, I try this couple of experiments, it works, I do more, it works better, I do more. So that kind of hunger, that kind of flexibility is also something that you're gonna begin to get an idea through conversations and through understanding how they see the world. That's why I say that it's not so much about being a specialist in technical terms, but a specialist on people, understanding how people see the world, and try to understand if that is the way that you see it, if you are aligned, if you want to go with them.
To follow on with that, could I ask either of you if you have a thought about if someone is really passionate about this and they don't see, as an angel investor, one of the things that we want to see is that the company is successful, that people are doing all of the things that you have suggested to take it forward. Are you worried at all that people might actually have to, they want to stay with it so much that they don't have an exit in mind? Or do you expect an exit? So I've sort of seeded that question with, is the best answer an exit? Maybe it's not. But what are you looking as an investor for in terms of that mindset?
I am putting my money in to get my money out. So there has to be a complete 100% agreement and alignment that I'm in it to be out, and I am out because the company IPOs, which is a very low probability event. I'm an angel investor, I'm not a VC, or it's acquired. So from the start, we all have to agree that if this thing gets to a place where someone makes you an offer and it's a good offer, you are going to accept it and you're going to follow your board's advice. So if you are looking to do a company for you that is going to be a very successful, extremely important, much more fulfilling, that is fantastic, but you do not want investors who are going to be with you 10, 20 years and then they are going to be pissed. So the most important thing for founders is to choose the investors that are going to be aligned with them. So the same way that we do due diligence on founders have to do due diligence on investors, and they have to have a very clear idea of where they want to go with the company and how they communicate to the investors.
Thanks, Javier. David, have you had some examples where you've had a mismatch between your founder's expectation of how far they were going to take the company and you as an investor?
No, I don't think so, because there's not, it's such a long period of time that there's not, there's either always going to be a mismatch, right? So it's like not something I necessarily look at. I think it's sort of a directional thing. It's a little bit binary, as Javier mentioned. It's if you are an angel investor looking for a return, then you have to be aligned with the founder and their wanting a return, right? Like that's just, it has to be that way, right? Otherwise it's a zero, right, chance of return for the investor, and so it's not a deal that you'd take. I think that there are investors out there, particularly like those friends and families rounds. If the interest is in supporting the entrepreneur, that's great. Supporting the entrepreneur to build a business that's not being positioned to sell is also, I suppose, okay. It's okay to fund lifestyle businesses, but that's not one where it's aligned with an angel investor that's looking for a return. And so I think, I have come across a lot of those companies, but I haven't invested in them, having kind of determined that. So there's always this question, is like, does the founder want to be rich or do they want to be king, right? And sometimes you can be king for a while, right? And then you get rich. That's fine. But if you just want to be king, then that's a problem. And so, I think that's something that you have to watch out for as an investor.
Thank you. So the length of time of the investment is one kind of a term. What other kind of terms are you looking at when you're considering a deal?
So yeah, I mean, the length is really a hard one, but you got to think of it in terms of IRR and time value of money, of course, right? So it's usually a function, right, of the return over what time period. And so if you just take those two together and plot them out, then you can kind of run some sensitivity on that and see if it's within your risk tolerance, which necessarily has to be very, very, high, because the degree of error is going to be very high, right? But another term that you have to look at, of course, is valuation, which that affects, right? It affects what your economic outcome is if they reach that exit in these different time frames. And so that's very important, and that's something that fluctuates with the stage of the company. It fluctuates with the type of company, right? Different companies get different multiples on exits, and something that changes with the macro environment. So you have to be conscious of that. But I think, that's kind of the obvious economics if you just get down and run the math on what exit scenarios look like under different scenarios, right? But the other thing I think that's often overlooked is like they're raising a certain amount to do a certain thing, right? And so startups graduate from one stage to the other, typically, right? That's why we have these sort of series of capital. And so if the use of funds, which I think is a term, right? Whether it's, it's not going to, use of funds isn't going to be stated in a note or in an equity agreement. It's always just going to say like whatever the entrepreneur wants to do with that money, right? But there is a representation being made to the investors as to what the use of funds is going to be used and what milestones they expect to achieve with the use of funds. And so you have to evaluate those and make sure that it is, that there's a high probability that they'll get to the next stage.
We started the conversation earlier with some brief discussion about valuation and what's been happening. In your wisdoms, and Javier, you've just been assessing this, can you talk about what's happened with valuations over the last any period of time you like?
I think that the important thing of valuation, there's many different aspects to valuation. I have a good friend who says that I shouldn't obsess about valuations because I'm going for the unicorn. So if I enter at 20, who cares if I'm gonna go out at $1 billion? So who cares 10 or 20 if at the end you're gonna end up with $1 billion? And if not, who cares? It's gonna be peccata minuta. It's not gonna make a difference. Well, that is a very ambitious, smart angel investor, VC. I'm not like that. I'm cheap. So for me, valuation matters. The difference between entering at 5 and entering at 20 in terms of multiple, given the probability of you are going to sell your company around $100 to $250 million, is humongous in terms of multiple. So for small potatoes like me, valuation matters. At the same time, valuation is never about this fundraise. It's never about this valuation. It's always about the next fundraise. So for founders, when you are setting up your fundraising, it's never about this one. It's always about the next one. What do you need to achieve by the next fundraise to be able to fundraise successfully? And how much money do you need to get there? And if you don't get there, are you sure you're going to be able to fundraise? If you fundraise at $20 million in 2021 and you have a recession in 2022, 2023, and then you want to raise at the end of 2023, and you are nowhere near where you can justify 1.5 to 2 times the previous valuation, it's like, are you going to do a down round? Are you going to do a flat round? Are you going to have to go back to your previous investors? It's like, it's your death knell, especially if you are in a down market where you are competing with a ton of people, a ton of supply of startups looking for funds, and there's a dry up in terms of funds available. So you have to be smart about it. That's why sometimes it's better to do a smaller fundraises. Faster, making sure that you get to the milestones that justify the next fundraise, or you fundraise always a little bit more, maybe at a little bit smaller valuation, because that way you have the margin of error of things that may go well or may go bad. Because at the end of the day, what investors love and what creates most FOMO is success. So if you are achieving the milestones that you set up at the beginning, everybody wants to bet on a winning horse. So if your startup is going through the paces and through the fundraises with the milestones being achieved, then you can demand higher and higher valuations, and that is fantastic. What I'm saying is that don't overshoot at the beginning at the peak of a cycle, which is what I've been seeing a lot in 2020, 2021. And that is what I think may be a problem, a point of problem for a lot of startups a year, 2 years down the road.
I'm going to put a reference in. You were talking about healthcare earlier, and I think that it has a long tail, and we could discuss that a little bit more. But here's just a reference on someone who was speaking about the changes in valuations in the healthcare space. So I'll just put it in there for anyone who might be interested in that. Nick's asked a question: what creates the most FOMO? No, a statement maybe is success. You want to elaborate on that?
Repeating something that Javier said that I liked a lot.
I like that too, yeah.
So, and that is important for founders. When I say that you have to frame things to your advantage, being very careful, not misrepresenting anything, is that you have to be strategic and you have to set the right expectations. So the expectations have to be ambitious enough so they can attract investors, because it's a high enough target. It's a market big enough. You are ambitious enough that this thing is going to be growing fast. So you cannot undershoot too much. But at the same time, you can manage the expectations to make sure that you are, it's like in the stock market. You have these companies that they are always beating expectations by 1 cent, the EPS. It's like, yeah, sure, because they are on the phone every week with the analyst and they are telling them, oh yeah, lower it a little bit, etc. So not going to that extreme, but you have to be smart enough to set up the right expectations that are ambitious enough to attract attention, but then they are achievable with a lot of effort, so you can keep on building the momentum. Because this is a play of momentum and inertia. The more inertia, the more momentum that you have, the more people are gonna rally behind you. And momentum is customers, is traction, is getting shit done. You're muted.
You can read this one. Jeff said, can you talk a bit about mission-based versus profit-based companies and investments? So I think that's probably a little bit more on the social impact side.
Yeah, I could talk a little bit about that. I think, angel investors have the benefit of investing in what they want to invest. And I think that all businesses, whether they're a social impact corporation or for profit, are mission based. And if they achieve their mission and they're for profit business, then profit's a nice byproduct, is the way I look at businesses, because they set out to solve a problem. When they solve that problem, they profit. And as an investor, you typically profit too. What happens after that point is, I can be kind of cynical about, right? After companies achieve their mission, they find reasons to stick around. But I think the same can kind of be said about nonprofits as well, right? And so I know it's a bit of a non-answer, but what it goes back to is what you are willing to invest in, what you want to see happen in the world. And so, VCs don't really have the benefit of, they're looking for the most profit in their investments, right? They're evaluating risk and looking for the most profit. But as an angel investor, you can align your values with your investment thesis very easily. And so there's companies that could be great angel opportunities, but you don't believe in their mission and you don't want to help them succeed. So you don't, right? Or there's others that you think that, man, they're going to have a really tough time making a profit returning this investment, but I love this entrepreneur and I want to see them be successful in their stated mission. And so I'll invest in it. And so I kind of take that as on a case-by-case basis. So it is, but I think the key takeaway is that, VCs and angels operate differently when it comes to those types of investments.
Yeah, and I completely agree. I think that at the end of the day, I tend to decouple does it work from optimization. So optimization is more on the side of how do we monetize, how can we expand margins, how can we add new revenue streams, how can we lower our unit costs, etc. And does it work is, are we solving a problem, a real problem? Do we have more and more customers who are willing to pay a cost that doesn't have to be monetary? It can be top of mind, it can be engagement, it can be many different things. So that can align perfectly well for a company that is more focused on the mission than on the profit at the beginning. At the end, you're going to need the profit, because without profit, this thing is not sustainable. But at the beginning, if you can show the inertia and the momentum that, hey, we started here, we are here, and we have this engagement, we have all these kids that we are helping because, and these are the real metrics of how this thing is virally growing and people are adopting it because it's really solving a problem, why not? That's fantastic. And then you have to find the angels that are aligned with that mission.
Any more questions just on that topic? Because I want to switch to something slightly different, so I open it to the floor. Can you talk a little bit about the difference in approach on due diligence from angel investors versus VCs? And I'm thinking when you're all curious, but you don't know quite how to be specific about the questions, how do we become efficient for our due diligence with analyzing a startup?
I don't know about VCs, but from an angel point of view, I started super serious and I created 5 pages of all the questions and all the issues that I had to touch on.
I have those still 5 pages.
So I used to do that. I still have them in the back of my mind when I am having the 1-hour interview with the founders, but it's much less intensive now. The due diligence is based on you understanding the basics of the model, of the space, of the customers, of the data that you are asking for or that they are giving you. And that has to be a serious exercise. The second thing that I would say about due diligence for angels is don't do due diligence alone. Find yourself a clique, find yourself a group, find yourself people who are orthogonal to you, who do not think like you, who you disagree with, and then everybody analyzes things from different points of view. And some of them are going to be experts in teams, like executive interviewing, or some others are going to come from the industry, so they know a lot about the industry. But at the end, everybody is going to give opinions about different salad of issues, and you have to listen to everything so you can filter out and get the best advice possible, which doesn't have to agree with you. But if you are in your own bubble, listening to your own loop, you are going to overblow certain vectors out of proportion, and you are going to minimize others just because everybody has biases. Like, for example, 2 biases that I have seen a lot in myself is that when you don't know anything about a specific space, you tend to believe, if you can visualize the solution, if you can visualize a future where the solution works, you tend to believe, to give higher probability that this thing makes sense than if you knew more. And on the contrary, if you are an expert on the space, you tend to diminish and see that, oh no, that is not going to work, because I've been working in this space for 20 years, and if that was real, I would have seen it before. So there's a lot of biases for and against that we are, and that's just an example that we are not aware of, and that's why it's so important to have this kind of due diligence with others and try to see things from other points of view.
Yeah, I agree with everything Javier said. I think it's really important to kind of understand your own decision making, right, and take a step back and do sort of the thinking. You're going to be thinking fast, right, when you're looking at startups and you're meeting with entrepreneurs and you're doing market research and things like that. You have to take a step to think slow, and I think that that's part of what diligence is. In terms of VC, versus angel, I think really the only difference is that VCs have to do diligence and they have to document it because they're accountable to their LPs. I think as a general practice, it's very good for angels to do the same because they have to be accountable to their past selves, right, and their future selves when it comes to investment decisions. And so I really treat diligence as it's more of like capturing my thoughts at that time, capturing, there's a lot of facts, right? You have to capture as well, right? Representations made by the entrepreneur, you got to verify those facts, usually by asking for supporting evidence of some sort. There's some basic diligence that you have to do on all companies as it relates to legal, financial, et cetera. But, in terms of your investment making decision, framework, you're trying to capture, right, the facts that triggered you to make or not make an investment. I think another thing to point out too is that, like, you only do diligence when you already want to invest in the startup. So you've kind of made the decision. So when you start to do diligence, that's the opportunity to play devil's advocate. And so you got to talk yourself out of the investment. And so that's hard for people to do, right? Because it's sometimes holding contradictory things in their mind. And that's uncomfortable for most people. And so, as Javier suggests, getting in a group where they can challenge thinking and share insights and share points of view and things is critical.
And I love this Spanish Inquisition kind of point of view, or devil's advocate, where you have to have Bayesian reasoning, and when you have to be able to identify, because as you read the deck, there's a lot of assumptions that you are taking for granted. So you have to identify the assumptions that you are taking for granted, and then you have to come up in your head. This is a fantastic exercise, so this is kind of very weird, very nerdy. But you have to come up with this hypothesis of how this data could be right in a completely different hypothesis. And it takes you very, very interesting places, and it gives you a lot of input about how founders think. So question everything and come up with alternative theories that explain the data. So don't just take the data at its face value to see if it is true. No, go one step beyond, find an alternative hypothesis that explains it, and then say, okay, maybe this is because this other thing. And then you ask, and it's like, oh my God, it was.
Now, just to illustrate, I can add an example too, because I think that this is very common. If you as an investor, fixate on traction, right? You see the traction, and you're like, okay, well, they got all these sales in this short order, right? And you're like, well, the market really must like this, right? That's the conclusion you come up with. And in diligence, you first verify is the traction real, and so you maybe ask for customer contracts or a statement of cash flows or something like that to show the receipts. But after you verify it, to Javier's point, come up with an alternate explanation. And one that I've seen, commonly is like, well, one explanation for all this early traction is that they leveraged their entire network, right, to get those early sales and those early pilots. And so is that repeatable? Like, often not, right? So then your assumption that the market is receptive to this is incorrect, because that traction is explained with the relationships that the entrepreneur had, right?
Another one that I have seen is in terms of domain experience of founders. You look at their LinkedIn and they explain their resume, and it's very impressive. And then you begin to wonder, okay, but if this was true, what else would I expect to see? I would expect to see this thing, this thing, this thing. And then you look for those things and they don't exist. And then you have to ask. And then you find out that, well, things are not exactly what they look like.
How often do people do background checks or how do you do a background check on a founder? Do you actually do it through signing up on a background check site and you're looking at their credit rating and things like that? Or are you doing it by interviewing with people who may be customers or maybe ex-customers? What kind of background checking are you doing to show that credibility?
It's a combination of it. So I mean, I personally have never pulled a background check on an entrepreneur, but I think that it's a worthwhile to do, right? With one of those automated services, it's going to tell you two really important things, right? One, like, credit rating is actually important, right? If somebody's in financial trouble, then that's just never good, right? Because it's just not good for a startup, right? But the other thing is, like, are they involved in lawsuits, right? If you see something related to securities fraud, like, you run like hell, right? And so, I mean, I can't think of like a successful entrepreneur out there that would have had a bad background check, right? On those marks right there. But yeah, you also have to interview. And so it depends. As an angel, it's hard because you can't really be that onerous with your diligence and say, yeah, I'd like to talk to, the last person you worked with, or your previous managers or something like that. But in VC, you definitely do, right? You talk to, you want to talk to a number of references, and you want to reach out to somebody that wasn't introduced to be an entrepreneur as well, right? To make sure that they pass. And usually that's, that almost always passes, but it's a good thing to do, right? Because it's like when it identifies an entrepreneur it usually identifies a fraud, right? I guess you should put it that way, right? It's very clear that when you can identify a fraud, and they can come off very, very, they're confidence people, right? So they can come off really polished and really sell you and be very charismatic, and then you find out like, well, they're a complete fraud, right? That doesn't happen very often, so I wouldn't be like particularly scared of it, but it does also happen. So I think like it's a good like check the box sort of diligence exercise.
Yeah, I have only seen one case when someone told me, hey, be careful with, because there's this thing pending a few years back with another startup. So those things, especially not because something happened, but because the founder never disclosed it. So it's like if they have a DUI or something in their past, it's like, okay, it's like I just want to know, you cannot be too hard, but you have to go in with open eyes. So I have never done a background check kind of lawsuits and things like that. I know people who do it, and it's not bad to do it, but I tend to rely more on people through LinkedIn that they have a strong connection with. So I can ask them about them as people and trustworthy, with someone that I can trust. And if you are in a group, it's easier to get to those connections and to do a background check that is a little bit more onerous, and also later on customer interviews, etc. Because if you are going with a group, you are writing a bigger check. So that justifies a bit more than if you are just a small check going to do heavy due diligence, bothering a lot of other people. But it's uncommon, very uncommon.
Uncommon. Okay, thank you. Thank you. Kathleen, I'm going to put you on the spot a bit. You are thinking about becoming an angel investor because you have a background in big tech. Do you have some questions that you might like to ask?
Oh, thank you. My background is actually both startups and big tech, so it's a balance of the two. In terms of questions for today, I'm watching the changes in the market, and I'm thinking back on my own experiences. Given the radical transformation in availability of finance, I am curious about valuations. I'm also curious about team composition, that balance of creative new ideas with some quote unquote old hands who've actually done this before and have experience. Let's focus perhaps on the team composition question. Is there any particular pattern that stands out in terms of having a blend of people who actually do have prior experience versus trusting those creative new ideas? Is there a combination that looks like a winning ticket or a winning combination that y'all would look for or look away from or avoid?
For me, there is, which is customer. It's like, I don't care about the creativity of the idea. I love fringe technology. So sometimes I will, against my best advice for myself, I will invest in crazy stuff because I love cool stuff. But it's always about the customer. It's like, how much customer discovery have they done? How many people have they talked with? Are they already selling the product before it's been even implemented? It's like, how can I know? How much do they know that there's data that supports that this is really a problem? So for me, at the top of the pyramid is the customer. The second rank is the founder. The founder is going to be the driver, but the signaling that the founder is going to give me about their knowledge and their obsession about the customer is everything. For me, and this is just for me, technology tends to be the cart and customer is the horse. So you can have the best cart in the world. If you don't have a horse, this thing doesn't move. So I don't care so much about the cart itself, because you can always build a cart. I want to make sure that the founder is completely and absolutely aligned with the customer. And if the cart then is fantastic and is fringe and is great technology, oh my God, I love it. But if there's no customer, there's nothing. So I want a team that is obsessed and is all the time talking about the customers.
That's a great answer about how do you really know this is a truly important problem and a problem for which people are willing to spend money. Thank you.
I would just add to that too, because you asked about composition, and I mean, it always depends, but using the analogy of the cart and the horse, like once you establish that there is a horse, right, and they've showed why there's a better cart, right, the composition of the team is all matters on them building that cart, right, and selling it to those customers. And so you're looking at specific skill sets there, specific competencies. And I think, again, going back universally, the founding team, all of them have to have leadership ability. Otherwise, you're going to expect, right, like there's going to be one or two of them maybe survive over the long term as the company grows. But if you have a very strong leadership team from the beginning, I mean, that to me is something that I love to see, that they can scale with the company, because that's a big thing that's de-risked.
Thank you.
I think you're muted again.
I know. I'm sorry about that. A number of us have met in the particular Seattle Angel Conference group or through this. Can someone talk about the ecosystem in the Seattle area for, if you're an angel investor, where would you go for resources? For example, there's the Angel Capital Association. How many times do people go out to that? Or there's Seraph. What other resources do you like to go to, or books that you like that would help an angel investor be more knowledgeable?
The Halo Report.
Oh, yes. Talk to us about what that is. Some people might not know that.
And in fact, the latest one just came out in the past week, I think.
Isn't that what I sent it to you?
Yeah, exactly. So it's a combination of the ACA and Pitch Book, and it is based on data. And I'm a data geek and love to see that. And so they request from angel groups from the previous year their investing information and kind of aggregate it. And what you're able to see is, so you never know anything about a specific deal, but because they get so many people reporting in, you can understand trends by region on different things, and in looking at valuations and completing a round, and where angels geographically are funding, whether they're funding in their own group or our own region or outside of the region. And it's they also have information on, which is something near and dear to my heart, which is funding of female CEOs and minority CEOs, to understand how that trend is working. And it gives, I believe, both angels and founders a little bit more of a peek behind the curtain of what's going on the other side. So I always like to kind of read that, kind of grok it, so to speak, and then kind of try and triage it in a way that I think both those audiences could benefit more from. So it's definitely great. It's kind of like that aggregate. I love to hear kind of the feet on the street from like Javier and David, that kind of thing, and then complement it on the other side with some of that information as well. That's the aggregate overall trends.
David, do you have a resource that if someone talks to you about angel investing and they want to understand more that you might suggest?
Yeah, there's a number of them. I was actually just looking up some of the Amazon links to link them in the chat.
Oh, perfect. Then
Yeah, the three that I kind of always go back to. I've read a lot of books on angel investing and startups, and so these three to me covers like most of it, and then you can get deeper into all kinds of other books because there's so many resources out there. But the one I find very good is the Founder's Dilemmas. I actually ask entrepreneurs to read that too. It goes through a lot of the common pitfalls, right, that startups encounter and gives examples. And so that's been out now for many years. I think it's a masterpiece. It's Founder's Dilemmas by Noam Wasserman. And then another one so that's sort of like that's a general sort of like, okay, startups are going to experience these problems, right? And so you can start to kind of, as an investor, look out for them or also give founders advice like based on some of those learned experiences. But the other one that's a little bit more, I guess, maybe technical would be I think it's, let's see, Venture Deals. It's Be Smarter than your lawyer and venture capitalist, and that's by Jason Mendelsohn. He was in Brad Feld, yeah. So Jason and Brad are with the Foundry Group, right, and well-known tech stars right now, which is pretty much everywhere. But Jason, I think, was the counsel for their venture firm, but also for Techstars for a very long time there. But that goes over sort of like all the basic, right? Like there's a little bit of legalese that's sort of, it's specific to startups, right? It's, definitely when you get into the economics of startups, but then also sort of, founders agreements and shareholders agreements and things like that. That's important to understand those so you can do good due diligence. And so that takes kind of a tops down. It's a very good way to get introduced to venture deal terms. And then the third is, and really this is, you just look up anything by David Rose. I forget his first book. I think it was just called Angel Investing. I'm looking for it here. But David was he the Angel Capital Association, Elaine, is that right? No, he's the founder of Gust. I think he was also a chair of the Angel Capital Association there for a while. But he's a long-term angel investor, seen a lot of things. He got very active on Quora, and so he answers a ton of questions on startups in Quora. So you can read a lot of like his answers there, which you'll learn a whole lot. But then he also has a book which is sort of basics to angel investing, and he's got a number of other books as well that get into more specific things, right? Blue Ocean Strategy was one of them, and so that's a really good place to start. But then also, like any of the venture capitalists, I think that the venture capitalists from 2000 to 2010. That era minted a lot of, mainly through like survivorship bias, right? But like it minted a lot of like the top VCs and angels, right, of the past decade. And the ones of the last, I should say the previous decade, like the last decade is the jury's still out, right? Because these companies are still operating and invested in and stuff. But from 2000 to 2010, a lot of bets were made by a lot of smart people, and they've documented those experiences now in books and a lot of writing. So that's a good one. And then Y Combinator, I think Javier helped me with this one, but Paul Graham's writing, I can't remember what the forum is.
It's a blog.
Yeah, his blog.
It's very good.
Yeah, Paul Graham's really good, but so there's a lot of people who have been very successful in that, again, like that post 2000 tech collapse, that were very successful as angel investors, very successful as entrepreneurs. And in the last 10 years, they wrote about it, right? And so, and there's going to be new stuff coming out in the next 10 years. But I think there's a lot of fundamentals in investing, and there's a lot of fundamentals in startups. And so focus on the fundamentals. Don't focus on like the stories of like, oh, this or that, because that's just all, that's just, it's history, right? Written by those who want it or whatever, right? So like focus on the fundamentals when you read these resources.
One book that the two books that I very highly recommend, Venture Deals, everybody has to read it. Investors and Founders. So it's simple, it's not terribly complicated. You don't need to read it in detail, understanding every single thing. You just have to get an idea of why it is written the way it's written, where are the important things that you have to pay attention to.
It's even as an audiobook in case nobody reads anymore.
Yeah. And then you have also one that I really like, Lean Customer Development by Cindy Alvarez, which I think it's, she's an employee of Microsoft, I think. So she's from here. And there's many books about customer development out there, like how to sell to your mother or something like that. There's another book called something like that is also very famous. But it's good because for the investor, it's going to put you in the shoes of the founder and the things that they should be doing in terms of understanding their customers and how to understand their customers in a way that is disciplined and that is serious and that is documented and that is fighting against their own biases. So those kind of things are good. I didn't read it the whole thing. I read kind of 2/3 of it. So you don't even have to take it too seriously. But if you can get the gist of what it means and how to do it seriously, it's super useful for investors too, because then you can ask the founders how they do things, how they do customer development. It's not only how many people they talk with, but what kind of questions they asked.
Yeah, I would add to just a kind of closing note on the resources. It's just as important to know what resources not to listen to, right? And so there's a lot of sort of self-help style stuff out there, right? Or like, this is the prescribed way to do, like, that stuff. Like if it sounds too good to be true, it usually is, right? And so I mean, don't get caught up with that. And I don't get caught up with the stories I was mentioning before. If there's like a narrative driven book and you think you can learn something from that, it's entertainment. You're just entertaining yourself, right? Because that's guaranteed, right? How it's written about today, right? Successes of previous startups. That's not how it happens, right? Yeah. It's like people like at the startups and people who are around them as investors think they kind of know on the inside like what's crap and what's not. And there's always this sort of revisionist history that it gets celebrated, and so ignore that stuff. It's just.
Yeah, life is much more chaotic, much more random, and things happen because of a lot of different stuff. And I would even say that pattern recognition is good as a first step to recognize the patterns and then discard them, because success is not a pattern. So a pattern can get you so far, but the best startups broke patterns. So don't obsess about, there is a formula, there is numbers that explain, there's rationales that you can build up narratives that explain things. Not exactly. Life is much more complicated and random. So run away from easy stuff.
That's a good point to end on, perhaps. No formulas, no pattern. You're creating your journey as you go along and taking the wisdom. But I think one of the things is you have to be curious, you have to be cautious, and that's why some of that risk graphic that I just put up in terms of investment risk. But I think that the best thing to do it is to do it in a community. And then you can bounce off ideas. Like when we were working through the do our deal screening initially, I often would say to someone, I don't really know the space. Can you tell me a little bit more about it so I can make a decision on whether I want to learn more? And that sounding board, whether or not it's in a small group or a larger group, one of the things that John will totally believe in is our network here. And so hopefully you've captured some LinkedIn addresses or made some connections. I know that David and Javier are quite willing to follow up with you on if you have a specific question on something, but keep coming back to this community so that we can help you out along the way. I suggested in the LinkedIn chat, if there was any last questions, I want to open it up to some people who have not really raised some questions. If you have some, then go ahead. And if not, we'll give Javier and David a round of applause here.
I threw a question in the chat if it's okay, not too late.
Please, no, it's not too late.
What are
Go
some
ahead.
problems that you want to see solved? And do you have any requests for startups, maybe related to a personal thesis?
So can you repeat again the question?
Yeah, it was two questions, but same idea. Are there any problems that you see in the world that you want solved? Any kind of startups that you're looking for? So I said, do you have any requests for startups? Like, oh, I'd love a startup that's working on this problem. And I thought maybe they could be related to a personal thesis that you have.
Yeah. No. I have a philosophy because I come from where we created this Holy Inquisition, is that I don't trust myself. I trust founders up to a point. What I do is I trust customers. So just bring me a problem that is supported with good, high quality, good amount of data that customers really have a problem, and I will follow them. Because I don't trust myself. It's like, am I sure that I can see a problem? I mean, am I suffering myself the problem? It would have to be me. Would I trust a data point of myself, as biased as I am, which is a lot? So not so much. And founders, because they have to be convinced and they have to be in it and there has to be fitness and they are going to go against everything to solve it, they are also biased. So that's why I want to have the data firsthand as much as possible, as high quality as possible from customers, whoever they are. So sorry.
Yeah, I don't have anything specific to share. I think I'd be kind of, in a way, uncomfortable kind of sharing some of the things in the world that I mean, we all have things we would love to see change in the world, right? But like fundamentally, I'm with Javier. I'm a capitalist, right? And I think that capitalism solves a lot of problems. I think it creates a lot of problems too. And so when I evaluate startups, as I said earlier, I think that profit is a nice byproduct of solving a problem for a market, right? It also can be a byproduct of other things, right? And sometimes too, it can be totally made up because companies are able to dump costs on the broader society, and that comes in many different forms, which obviously is very subjective. Sometimes it's very objective, right? When you can get science and things involved. And so there's certain things there that I would love to see companies stop, dumping costs on the rest of the world, right? And in those cases, I want to see companies that compete with them and create new technology and can displace those types of companies that are profiting in what I would view as like an ill way. But then just generally, like any companies that profit, that are building things that customers, to Javier's point, see as valuable, they should be rewarded for building those things. It's really, really hard to build those things. And so profit is what you get. You can get kind of cynical on these things too when it comes down to the markets, right? Because like at the end of the day, as angel investors, you're investing in a startup with the expectation that somebody else is willing to buy your shares from that startup, right? And so we have certainly, like, I think in sort of, if you believe in late stage capitalism, we've constructed this world where there's a lot of companies that get bought that don't provide much value, but early investors still get paid. But again, that's subjective. Like that's maybe my point of view, and somebody else obviously has a different point of view if they're willing to buy those companies. But that's the name, that's the name of the game. That has to occur in order for people to have, the motivation to build things and do things in a capitalist world. And so that's kind of my viewpoint.
At the same time, I will not invest in everything. I mean, there will be certain things that I do not want to be associated or invested in. And there's others that if they have a positive effect on society and the things that I hold more dear, I will have a lower barrier of perception of risk, because I will want that to succeed. But then it gets personal.
I appreciate both of your answers a lot. Thank you.
Thanks, Nick. Sorry, I missed that earlier. Elaine, you are our closing out comment or question.
And actually, just as a closeout, there, I had two kind of big takeaways from David and Javier today. I want to thank him for both. It's always great to hear those references and be reminded on the references that people are using. to always kind of add to my bookshelf. So thank you for that. And then for underlining the fact that due diligence and investing together for the diversity of opinions is important to both of you. I feel lucky to have been able to invest alongside both of you in a number of investments. Hopefully we can do that again, but that ability to kind of leverage others' knowledge in the areas that you're not so, top of the morning on, I think is really important, and really appreciate the fact that we've been able to do that together.
It's been a lot of fun. Thanks, Elaine.
And Seattle Angel Conference is the fantastic place to do it, because that is where we met. That's where we met. We have been over the last 6 years talking, participating in different events. We are in different networks. We have created our own little cliques outside from the friendships and from the collaborations that we did in Seattle Angel Conference. So look at Seattle Angel Conference as the beginning of a path of your own investment thesis.
And if you want to sign up to get connected either as a startup or as a founder, Alex Alviar put some links in the post, and he's happy to talk to you.